Okay, welcome back everybody. I hope you had a good lunch and break. Now, the post-lunch challenge will be in the hands of a group of people. So we will have a panel discussion. So we will go through the topic that we will cover is emerging markets, risks and rewards. The moderator of the panel will be Ahmed Fayed El Gebali. Again, sorry for the pronunciation. Ahmed has a big level of expertise in the retail and investment banking environment and has thorough knowledge of business evaluation, investment appraisal, and due diligence. Then another panelist is going to be Josema Ship Chandler. Very close? Okay. He's a CFO for General Electric in the Middle East, North Africa, and Turkey. Then another panelist is Adnan Anwar, Chief Financial Officer, National Bank of Fujairah. Yeah, very easy, actually. Thank you very much. Yeah. Adnan has over 14 years of experience in banking, financial advisory, consulting, finance, accounting, and auditing. And then the last but not least panelist is Abdul Aziz Abdul Kadir. Was that right? Good. Almost, okay. That's the best I could do, sorry. Director of Finance, Strategic Planning, and Company Secretary, Sabre Travel Network Middle East. He's Director of Finance, Operation, and Secretary to the Board for Sabre's entire Middle East operations. He's also CEO of Sabre's company in Egypt and directly responsible for leading their Middle East organization. So, welcome all the panelists on stage.
Globally, Asia today is the major hub for all M&A transactions. Countries that are contributing towards this economic optimism are Japan, Thailand, Indonesia, Laos, Vietnam, Myanmar, India, and China. Let us catch the emerging trends of each of these countries and their appetite for mergers and acquisitions. Japan has witnessed the negative impact of triple disasters, earthquake, tsunami, and nuclear crisis. However, this has not stopped the M&A activity from going forward. Japanese corporations backed by a stronger yen have now been forced to loosen their surplus purse strings and indulge in attractive outbound M&A deals. The Thai government embraces foreign investments and has over the years relaxed its restrictive laws, granting waiver on certain taxes and duties on M&A deals. Thailand has been part of the ASEAN Free Trade Initiative. This makes it attractive for cross-border mergers and acquisitions. On the downside, it is politically unstable, and this weakens investor confidence. Foreign investors also need to be a bit cautious while retrenching employees, as labor laws are more employee-biased. Here, legal due diligence is not a statutory requirement, so a thorough reconnaissance is recommended before buying property here. Indonesia, with its abundant natural resources and vast population of 240 million, ranks as the third most fastest growing economies after China and India, and amongst the G20 most industrialized and growing economies. Banking has been the most successful of M&A ventures, despite this sector being the most regulated. In Laos, mergers and acquisitions are still in its infancy, but are showing a promising future. This is mainly driven by government's openness to FDI and market reforms. Another advantage for Laos is its geographic proximity to neighboring Thailand, Vietnam, and China. Myanmar is still a virgin territory. There are no dedicated securities and exchange control laws in Myanmar. Even the term merger is not found in the Myanmar Companies Act. Words such as reconstruction and amalgamation are used as a medium of expression to define a merger. In Vietnam, M&A activity is on the rise. This country has a sizable, dynamic and youthful market. However, to date, Vietnam has no single comprehensive M&A law. Rules are seen scattered in different pieces of legislation. Hurdles remain in regulatory and legislation areas. However, despite such limitations, M&A activity would be the key entry point for foreign investors. Since liberalization in 1991, India has enjoyed robust and continuous growth in inward investments. So there are fewer challenges on inbound deals. However, single brand retail, insurance and defense still follow a restrictive strategy on M&A deals. Lately, overseas direct investment or the appetite for outbound deals has grown significantly and is no longer limited to prominent business houses such as Tata's, Birla's or Reliance. Rapid economic growth has provided an opportunity for young businesses to expand their businesses outside the Indian shores. China is clearly the tiger in the M&A field. Strategy for outbound investments are in the area of resources, manufacturing, technology, telecom and financial services. The Chinese march is robust on Southeast Asia. Inbound investment at times gets delayed, mostly due to cyber security reasons and cultural differences. And now the India story. Buoyant optimism among Indian operating companies aided by robust growth has paved the growth for M&A transactions. From a deal-making standpoint, business in India has matured in recent times. The hunger for Indian buyers is ever evolving, particularly the mid-cap growth companies that are gaining prominence and credibility as global players. Indian owners are aware of inherent risks that go along in making transactions in terms of financial due diligence, including integration issues relating to human capital and IT environment. Although the number of deals have reduced in the last 2 years, but the value of the deals are on the upswing across sectors. From a legal standpoint, the recent spate of changes in the regulatory framework on the proposed takeover code will have a bearing on M&A transactions going forward. Furthermore, the Government of India's initiative in further liberalizing the policies on foreign trade and investment will provide a thrust and a drive on M&A activity. And now, a few illustrations on M&A activity in 2011.
بسم الله الرحمن الرحيم والصلاة والسلام على أشرف المرسلين سيدنا محمد وعلى آله وأصحابه أجمعين. Actually, we feel so proud of what has been presented in the video, has been watched by all of us. It's a very interesting subject and topics to discuss today with our panelists here, especially after the Arab Spring, which is we hope one day to achieve what has been achieved in Asia. And we feel proud of what has been achieved, and everybody in this country should be proud and happy of what has been achieved. And we hope that what has been changes now in our countries to lead us to the same results, inshallah. Talking about the emerging markets and comparing between our situations here and the BRIC area, which is Brazil, Russia, India, and China. We have 3 topics actually we are going to discuss with our colleagues here, which is talking about the first topic. It's related to the brick wall falling apart and how safe are the new emerging markets in terms of doing business. At the same time, after the uprising in the MENA region, our companies are still looking towards the Middle East as an opportunity as emerging markets. So I would like to give an introductions about the subject and the topics that we are going to discuss and the questions we're going to be raised with my colleagues here. In emerging markets, a bottom-up approach is generally the most effective approach. We cannot only rely on the nation initiatives or the macroeconomic policies to foster the sort of growth and stability that this market so desperately needs. Even when it comes to the international aid to these countries, there are a growing number of voices questioning the wisdom of the historical top-down approach that delivers massive amounts of direct and direct aid to the government itself and to the consultants and the middlemen. Instead of investing in the small farms, business and communities, enabling them to be self-sustaining. From the investor point of view, markets in developed nation present a lot of challenges, but these challenges are compounded when investing in the emerging markets, in part because acquiring information and rely on fundamentals in this type of countries, it's very difficult comparing with the developed countries. So I would like to start actually my questions and discussions, and we will be more than happy actually to receive your questions during our discussions with our panelists. The first one, which is we would like to take your opinion about, is the BRIC, Brazil, Russia, India, China, wall falling apart? What's the BRIC economical potential based on your experience and having business in this type of countries? So I'd like to start with you, Mr. Khuzaima.
Well, I don't even think the BRICS are close to falling apart. So I think any suggestion of that is just wildly overblown. I think that all of them are running into various challenges. We're seeing some of it play out in real time. India is going to have to deal with some level of social unrest as they kind of work through corruption and things like that that we all read about in the newspapers. I think China, any suggestion that the housing sector is going to completely derail the economy, from our perspective, again, I'm speaking from a GE perspective, I just don't think it's going to have the lasting effect that a lot of people do. I mean, the fact is that the government has a variety of tools at its disposal to continue to stimulate the economy, and while, again, they're going to hit various speed bumps, I just think it's such a large consumer environment that for a company like ours, there's nothing but upside there. I think with respect to Brazil has still not quite seen the development that China and India have, and so I think Brazil is still starting. And Russia, for all practical purposes, while being intensively resource rich, hasn't gone through the same cycle that the other three have. And so while a lot is being written about political, depending on your point of view, stability or instability, I think Russia, for us as a market, is just starting and is going to be incredibly large.
Mm-hmm. So do you believe that is the BRICS decade, is it the BRICS decade today? Is it their time still?
Well, I think it's the BRICS time. I think it's, my region is the Middle East, North Africa, and Turkey. I think it's our time. I think it's Africa's time. So I don't think that, I think it's dangerous to paint the world in the form of BRICS or the Middle East or Africa. I mean, the fact is that every single country is different. And I think it's dangerous to label any one region with overall demographic trends. I mean, obviously there's a lot happening in the Arab world today, but again, the situation differs country by country. The resources differ country by country. The culture and the heritage differ country by country. And I think that to be successful, the more that we are aware of that, then the more successful we'll be. I think, on the whole, for us as a predominantly historically U.S. company, there's nothing but upside as we look at Latin America, the Middle East, Africa, any of the BRIC regions, Southeast Asia, and Australia. I think, if anything, the slowdown is happening and will continue for an indefinite period in the U.S. and Europe.
Mr. Adnan, actually from a banking point of view, how do you see such market, and the same questions. Actually, would like to know what's your opinion about that.
Thank you. I think I agree with what my folk Ahmed said, but slightly different perspective from the financial sector. I think if at all, probably BRIC or emerging markets may have an opportunity to collaborate more. And if we see particularly BRIC over a period of time and in decades, almost 20% of their GDP comes from exports. And primarily, apart from, I think, India, Brazil, China, majority exports remains to the developed part of the world, US, Europe, those parts of the world. And where we are seeing those parts of the world seeing some difficulties and slower growth rates, there is an opportunity for these blocks to think differently. And already when we see different statistics being published, India and Brazil, their primary trade is happening with emerging economies now. So the majority trade is happening within, or their counterparties are from countries from emerging markets, as opposed to China, where majority trade happens with US and developed parts of the world. So there is an opportunity, as Ahmed said there, and the video also talked about it, the rules, regulations, different perspectives, they may have to be considered. Often emerging countries, they do not look into themselves that well. The connection between them is improving, so I hope that will continue to be the case.
One more question actually to you, since you are coming from a banking background. Will the BRICS equity outperformance will continue, especially in such time of financial crisis?
It can happen. I think the equity performance outperforming market is a reflection of companies' performance. So even GDP performances and the growth rates, they do expect to be slowed down in BRICS and emerging markets as well, but they are far higher, even in any economic report you would see, than to developed parts of the world. So I still feel you have to play rightly. Your strategies have to be correct, and there is a potential that they still may perform better.
Mr. Abdulaziz, I would like to have your point of view on such.
Okay, what I see, emerging markets were never a free ride. It was a plus from the business side. Countries were going, investing in there because of the high returns. But at the same time, it had economic volatility right from the beginning. It had political issues always in all those countries. The policy risk is always there. The ever-changing taxation law or the policies of the government, foreign and internal, they were always the risk right from the beginning. Transparency, governance was a problem, and even the capital outflow had a lot of restrictions. But what we see among all those problems in those emerging markets, the businesses keep on improving. If I specifically see the travel industry show 8% plus growth from the emerging market last year, 2010, among all the global crises and all these, whatever happened. That shows the strength in these countries, because when the developed country had problems in their own country, in their own home turf, they divert the business towards these emerging markets, towards the BRICS. You call it India, or you call it in Africa, or even Middle East was booming at the time. What I see, developed country like US used to have about 30% of this $1 trillion industry, travel industry. Now they are 25%. The business shifted from them towards China and India. So it's a business is diverting, but it's not evaporating from the system. It is there. It will remain there. If it's a $1 trillion industry, it is still $1 trillion industry. It's just a shaking hand from one developed countries going towards the. So that is actually providing a base to understand and to think that there are still positive factors in the emerging market. I can see the forecast, which is coming, usually those all Gallup's type of companies prepare. They think that the travel industry keep on growing till 2015. And that will be on the back of the developed countries because their business is going down. The travel industry is shrinking in that Europe and American. But at the same time, the next 3-year forecast shows that China will be doubling their travel forecast from what they are now to surpass the US travel data. That is, from my perspective, from travel industry point of view, we are quite high in hope with this emerging market. Positioning it in the Middle East also, yes, we have more political issues that we used to have before, but if you see Middle East as a whole, not every country has the problem. Yes, there are political turmoil in Egypt and Syria and Yemen, but still, Saudi is growing and keep on growing. We don't see any drop in the business travel or the corporate travel. We don't see any religious traveling for Hajj or Umrah drop, actually it increased. The only travel which is dropped in this was a temporary in 2-3 months when the turmoil actually happened, but then it comes back. A shift from Egypt towards Dubai, a shift from Bahrain towards Saudi. It is shifting, it's shaking hand from one country to another. But the strong thing in the Middle East is it's not a one country. It's a portfolio of 13, 14 countries. And the business is moving from one to another. But I think this place is still quite an investor's market.
Yep. Okay, coming back to Mr. Huzaima, talking about why, although we have a lot of recent volatility in the emerging markets, but still I understand that still most of the companies, they have the interest to do business in the emerging markets. How the companies managing their strategy towards such expansion or such business to do in the emerging markets? And what type of context the risk in emerging markets today that we have to consider?
Well, I think first of all, to answer the first part of the question, the biggest, probably the most deliberate thing that we're doing as it comes to the volatility in the emerging markets is that you have to take the long view, right? And I think any macroeconomic trend that you look at between now and the next 3 to 5 years is very positive. And so whether it's GDP or FDI or the price of oil, frankly, which is obviously has a profound impact in the region here, all signs point up. And so I think if you look at the macro trends, you should feel good about where the economies of the region are going, as well as the broader BRIC countries in Southeast Asia. With respect to the short term, it's going to be bumpy. There's no doubt about that. And let's just take Egypt as a case study. I mean, Egypt, it's unclear who exactly even signs a document if you want to do business there today, right? I mean, the government, as it stands, is a bit of a revolving door of officials. Ministers are changing day by day. Some people are being put in jail. New people are being appointed. Then they're being told to leave. And so it's very unclear. But the fact is that it is the largest country in our region. It probably will have among the largest GDPs longer term. It has tremendous potential in terms of the intellectual capital of the country, and there are acute needs in sectors that matter to my company: energy independence, healthcare, transportation, and water security. So when you think about the needs and you marry it with the long-term financial projections, I think things look pretty good. And I think you can go country by country and do a very similar analysis and come up with more or less the same conclusion. Now, I think what we have to be careful about as a company is that we're not so arrogant that we think it can happen in a quarter, right? I mean, a lot of American companies, we're no exception, tend to get overly quarterly focused. And this is not going to happen in a quarter or 2 quarters or even 10 quarters potentially. I think that we have to be careful about the size of the investments that we make. We're going to make them, but we have to be careful about the size. I think we have to be even cleaner than we had been with respect to transparency. I mean, I think that, as Abdulaziz mentioned a moment ago, I mean, transparency has been one of the major reasons that we've seen some of the upheaval that we have. We have to ensure that any of the deals that we do are crystal clear in terms of the transparency that's involved. And I think the last thing for us is that just from a human capital standpoint, we've got to have people on the ground, but when we, and locals on the ground, and when we put those people on the ground and we put them in a position to do a deal, we also have to ensure their personal safety and security, which, you know, can be a risk in some of the regions that or some of the countries rather, that we're seeing today. So I think if we can make that equation come together, then we should be fine. And I think it's going to work out okay. You know, and Abdulaziz and I, for example, were talking about Iraq earlier this afternoon, and I think that's a country, for example, with tremendous upside potential. You read about security threats, but I think it's, again, wildly overblown. I think the media makes it out to be worse than it is on the ground.
As a banker, I have a personal questions to such approach that you are talking about. I wonder how a company like GE calculate the cost of fund, especially in a country like Egypt or Libya or Tunis, since we have now a very high political risk. We don't know, even you are talking about, you know, you don't know who's doing what. Even as Egyptians, it took for me 3 months to renew my passport, my Egyptian passport. So I wonder how much it costs you. As a banker, I'd like to know that, how much it costs you from the risk reward concept.
Right. I think, I mean, first of all, we're probably not going to do much borrowing in Egypt. So just as a starting point, I mean, we do most of our borrowing very cheaply in the United States, in Europe, and to a degree in Japan. So I think from that perspective, our cost of funds will remain relatively low. I think the question is more on the side of how risky an investment do we have to consider, and how high does the IRR have to be relative to our weighted average cost of capital. And I think for us, again, conventional measures of financial performance, they don't work in some of the markets that we're talking about. If we were slaves to return on investment or IRR, we would probably not be in some of the markets that we're in today. I think if we take the long view, 10, 20 years from now, I mean, the Middle East is going to be a hugely successful economic bloc. And I think that my focus as the CFO of this region is to get people to look away from a traditional measure like a cost of capital, like an ROI, and to think about, you know, things that marketeers think about, market share and demographic shifts and what the business could be 10, 15 years from now.
How GE is thinking as a CFO of GE Middle East and North Africa about the currency risk actually that you are taking, especially you are seeking your funding from outside of the regions, which is cheaper than what we are talking here about.
Right.
But in the same time, there's and you are carrying a currency risk which is very heavy, especially in such countries like Egypt, like Libya. You can today you can sleep and wake up with a different rate of currency. So. Very sensitive area. So how you manage this?
Yeah, well, look, again, I think it's like any other situation. I mean, diversification counts. And so it helps to have a variety of bets placed in different countries. And I mean, if the entire world goes to hell in a handbasket, then yeah, we're going to be in a pretty tough situation. But I think as one country underperforms, another country tends to overperform. And so we find that having a basket of a variety of bets has worked out pretty well for us. I think the other thing is that we're in industries, energy and aviation in particular, that tend to be largely dollar or euro denominated. And our cost base is also largely dollar and euro denominated. And so we have a bit of a natural hedge there. And so to the extent that we face currency risk today, it's predominantly in the euro. I would imagine it's the same answer for most people in this room, actually. Today, it's predominantly the euro. We are facing some issues there that we're working our way through, but local currency risks, we're not seeing a lot of them, and frankly, in the Gulf region, a lot of them are pegged to the dollar anyway. So we don't see tremendous risk as far as currency goes.
Adnan, would you like to share with us your point of view, please, on this?
I think Josema has covered quite a lot on that. And which place is safe to invest? My question is, when you see Europe and US, it's more how you manage things. And volatility in itself provides opportunities. So you just have to be careful that what you do, you know it well. So even just any newcomer going into emerging markets, oh, emerging markets are going to go up, let's put in money. But we have to be careful, as we were discussing in the morning, what are our core competencies. So we should never forget those aspects while we are going into that. The tremendous thing which these parts of the world have is the demand, is the national demand. The population, almost 2/3 of the world demand resides in these parts of the world, which in a longer term will remain there. There is a lot of room for urbanization, per capita GDP income in these parts of the world to improve, to match and develop economies. So there will be ample room in times to come for development in this part of the world to take place, as the population is there.
Thank you, Adnan. Mr. Abdulaziz, would you like to share with us your point of view, please?
Look, our strategy, how to do business here is pretty much simple, that we see the entire Middle East as one big pot for us. So in some countries, we have more leverage to go and do business because of the population base and because of the pretty much stable political situation, and some countries we don't have. But still, what we are doing for the past 2 years, and we continue this year, is the investment. I fully agree with Maitra, if he was here, that this is the time to do the investment, because we are cutting a deal which we could not have done this before, and we are basically capitalizing this. What we are concentrating here at the moment, because we believe that this situation will not last forever. I mean, if there is a political uncertainty here, there are situations going bad, this will not remain bad forever. It will bounce back. So our strategy is to increase the market share. And we keep on buying business and increasing the market share. And on top of whatever happened in Egypt, our market share increase. And that will give a serious boost when the market comes back, because then it will be coupled with, it would be a double-dimensional effect of market growth and our own market share, which is sitting on a higher base. We are opening more branches in Saudi. Now this year, we are planning to open another branch. We already have 10 branches in Saudi only. So that's how, because we see the business here, especially travel business, is like, if you do an advertisement, people don't even look at the advertisement. They want the business at their desk directly, and then they do the business with whoever comes first, kind of a thing. That's why we believe in investing in the manpower, investing in the resources, investing in the infrastructure development, and that pays back, because then we are where the consumer requires us to be there. This is what has happened. Now, Iraq market, like Khuzaima mentioned, Iraq market is a very open field. It's a very unsecured, high-risk market, fine. But we are managing our business through Jordan, because we have a right partner, which is local. They have roots in Iraq. We're managing business there. At the same time, what we are doing, because the banking industry is like they have no infrastructure at all. There is no clearance. There is no interbanking transactions happening. So what we are doing, we find a partner, which is a German-based partner, and they are willing to invest in there to develop a parallel banking clearing house kind of a thing. And that we are not doing for ourselves. We are doing for the general market. When the market develops, we grow, because we are the pioneer in the market. We are already there. We have opened our offices in Iraq, in Basra, basically. So this is what we are doing. This is the time to invest in those markets. The investment will not pay you back this year, will not pay you back next year also. But it will pay you back in 3 to 5 year time. And when it will start paying back, it will dilute all the risk that we were actually looking for, all the losses we will have in the first 2 years. This is still, I believe, and this is what we are doing. Our strategy is to invest in this market and grow market share and sit on a higher platform to see from the top when the market is start stabilizing.
So we can summarize that although there is a volatility in such markets, and it gives better value now comparing to the rest of the world, yep. But all the companies or big companies, they are concentrating on more long-term strategy, more than short-term or medium-term.
I will add one more thing into that, what you say, long-term strategy, because the developed markets, developed countries market, it is more stable. It is stable when there was a good time, good for a stable business, less risk. But now when the bad time comes, also it is stable in a bad time also. So it will remain there for a long time before they actually start showing. It's a larger economies, they are stable economies. So the bad time also is stable for them. You can't see overnight 2-3 years US or a European economy will turn around and they'd say, now we are doing a fine business. It's not going to happen. So where the investor will go? Money is just not burned somewhere. It is there in the system already. So it will move from Europe, if that's not profitable business, to the emerging market, Middle East mostly, because they have most profitable business here.
Actually, now we are reaching the final topics, which is, still we have time? Yeah. Actually, the most important topics for me, and maybe most of you would love to discuss these topics, which is related to our region, our MENA regions here, especially after the uprising in the MENA regions, and are the companies, as has been mentioned, all the companies still looking toward the Middle East, as you have been mentioned, the Egyptian market, Iraqi markets, and Libya coming, and Tunisia, and the North Africa, actually. So I would like to discuss actually a few points here, which is, what's the risk of today positions, especially after the Arab Spring, towards the rest of the regions, and how this will impact your business in this area, and how do you see the future of this market as a MENA regions? Can I start this?
Yeah, for us, as I said in the beginning, all we see is upside as a result of what's transpired in the region. When you think about the big themes that have come out of the so-called Arab Spring, security has been a big theme, transparency, compliance, efficiency, jobs. And I think these are all areas where GE in particular can play a big role. And when I think about the way we're positioned as a company today and where we can be positioned as a company in the future, I think about the businesses that and the products and services that we offer. Healthcare, again, is a very, very acute need. And I think when you look across all of the countries that had some level of instability, every single one of them demanded better access to healthcare. And so I think for a company like ours, that fits perfectly. I think with respect to our energy businesses, we all realize that there's a vast amount of natural resources in this region. Unfortunately, there are two problems with that. Number one is that not everybody has access to the grid. And secondly, a lot of those resources end up getting squandered. And I think that what you've seen happen, again in part, is that people have demanded that whatever the wealth creation effect has been, that it has to be more broadly distributed across the middle class versus just to the elite. And what that's going to mean for us is that more power generation capacity has to come online, and that's going to be good for us in the short term and long term as well. And then I think when you think about things like water and transportation, infrastructure needs to be rebuilt. People want to have access to clean water. They want to be able to fly home and see their parents or relatives or loved ones. And so, again, all of those things are going to play right into our hand, I think, in terms of the products and services that we have to offer. I think the issue is that are we going to have the stomach to do what it takes to win the business? There are no shortage of opportunities, especially as it relates to what's just transpired. I think the biggest issue as a company that we're going to have is can we put enough local talent on the ground that can transact business locally and help us win locally, and which kind of leads me to the last part of what transpired in the region. I mean, unemployment is chronically high in virtually every country across the Middle East. And for that ultimately to turn around, that means that multinational companies are going to have to invest in local manufacturing, local technology, local repair, education arrangements. And again, I think those play nicely into what GE can offer as a company. And so long as we can execute on what the desire of the region is, then I think, as I said in the beginning, there's nothing but upside for us.
Then as a banker, how do you see this? And in addition to that also, what's the criteria should be used today to reprice the political risk and the credit risk, especially in the emerging market in the MENA region?
I think those countries which have been directly impacted in short term from financing perspective, or whether you talk about ensuring risk perspective, there will be restrictive appetites. So banks will be slightly more careful, and they may be pricing premium, if at all, if some of the banks, they lend from outside those countries. But over a longer term, it could be a different picture. As my colleagues earlier also said, a lot of companies and businesses are relocating themselves in other parts of MENA region because the wealth surrounding MENA region, energy, resources, and what all is happening around emerging markets is big enough market for all the global players to be present here. So I don't think that multinationals are going to close down their operations just because what has happened. Because it is that significant part of the world's business which people cannot ignore. So we also, in UAE, quite many businesses started moving their head offices or representative offices. People will find way to deal with the problem, but the demand in business will remain there. And I think that will continue.
Mr. Abdulaziz?
I think the current environment, if you see the next 12 months from now, the risk is significantly higher. Very high, actually, because you never know. The fire that started from Tunisia is already burned half of the Middle East, and who's the next? There could be anybody, because we see some demonstration happen in Oman also, in Sohar area. We see some unrest in Saudi, eastern and central provinces also. So we never know who else will come into the net. But the thing what we are doing, our strategy is that because we are staying here for a long term, it's not like we're not a stockbroker, the stock finishes, we go home. We are here in this industry for a long time, and then we're going to stay here. So our strategy is to capitalize the situation, which is to find a right partner, the strong partners that will run our show locally for the time being, and then we tied them up with our partnership of exit clauses. So they will exit after 2-3 years. They will bear some sort of a risk. And this is what we are doing. We tied up with Emirates Airline, we tied up with Gulf Air. We have our strategies around working fine. So we say that next 3 years our profit margin will be a bit lower because we have these strong parties behind our back, and they definitely take their share. But after that they exit, and then the market is ours. And when they exit, it's not that they are taking the business away from there, of course not. Because once technology you sell, the technology remains there. This is only a partnership will go off. So this is, I think the main theme of here is, the risk is very high in this region, fine. But if you're trying to mitigate or cover your risk, you need to find the right partners. You need to invest in this business so you are there. Again, what I say, if market share is, you're sitting on a high market share now, in the 3 years down the line, it will start producing the fruits.
Talking about the risk-reward concept in such a region and emerging markets that we are in, from your point of view as GE, CFO of GE, North Africa and Middle East, how do you see the difference from country to country when you are assessing the risk-rewards concept? Especially there is a country with more transparency, and there is some fundamentals, and other countries, which can be the neighbor of such country, with no transparency, no fundamentals at all. How you differentiate between this, and how you assess the risk-rewards?
Yeah, well, I think for us, first of all, we don't have a lot of choice, right? I mean, we have to go where the growth is. And so if you want to grow as a company, I think that you can't just say, well, it's hard to do business in certain places, and so therefore we're going to look elsewhere. If there were other places to look, I'm sure we would be there. So I think for us, we're going to have to focus on the Middle East and North Africa, period. I think with respect to country and some of the differences, I mean, my view, and I've actually heard government officials say this to me directly, is that they want more help sometimes than it seems. And so I think if there are things that we can do for them that help them increase transparency, then they're very open to it. And so to me, the issue is not one of one's less transparent than the other. I mean, we're going to be transparent no matter what, and we're going to live up to a certain standard of compliance and integrity in all the business that we do. If less transparency exists in a certain country, we're going to partner with that country and help them run a transparent process, and if they're not prepared to do so, then we probably won't do business there. But as far as the risk-reward trade-off goes, I mean, the way that I think about it is that the rewards are high pretty much everywhere. The risks exist, but they're in all sorts of different dimensions no matter what country you look at in the world. I think the MENA region is one of the best, probably the best right now, and I think you have to be here. So we're undeterred by the level of risk that we see.
Yeah, thank you. Now we would like to open the discussions with our distinguished guest. If you have any questions for our panelists. Please.
I think I covered that.
Please.
Every time there is an American sneeze, the world shivers. That whatever happened in the United States hit the Eurozone. What is so special that we prevent or protect MENA and the Asian market from falling victims of going the same way America and Eurozone is going to?
Well, difficult one. I think it will take some time, if not quite many decades, to resolve that, if the political will or the gender will exist. Talking about MENA, all the majority currencies are pegged to dollar. Dollar is a primary currency across the globe for, by large, anything. The size of economy of US is so big that the trade flows, business links are all the world are primarily linked towards that. So hence the impact is so big. Has anyone recognized that? Has anybody seen that coming? 5 years back, probably some people might have done that. Today, I think all of us as CFOs in our companies, in our internal meetings, discuss much more than 5 years back the global environment, the US impact, and how they are causing our business to suffer, and we are reflecting in our strategies. So I see all of us have become increasingly aware of external markets, which is a good thing, and we are thinking on those lines how to correct the situation. So I can tell you some of the things which we follow. For the past 2-3 years, we see the level of investments going in US, even from countries like China, have reduced a bit. China still holds more than 1 trillion in US treasuries, but it held around 3 years back 1.4 trillion. The amount of gold which is being purchased by India, China combined in the past 3 years exceeds the global, or it's absorbing almost 80% of what is produced by the world. All the supply is going there. So people are doing, but these are shifts which takes decades. For the past so many decades, US has been there, so integrated. So people are aware of that. Change is happening. The global environment is still difficult. In my session tomorrow, some of the facts probably I'll share with you folks. The level of debt which US and Europe have against their GDP is phenomenal, but it has not grown in 1 year. It has always been there. Why only in 3 years we are talking about it? So the trends never get developed overnight. They are there, but as you say, when things are going fine, we all close our eyes and start following the herd mentality, as we say, just like UAE. An example very close to us. We all used to say real estate is a bubble. Almost all of us, or most of us, got into it. So it does happen, but I think if you ask me whether the change is happening, I think the fact that we realize that and we are talking about it in our internal meetings, in our discussions, I think it is happening. And in some parts, it is happening at a faster pace than perhaps we all realize. That's what I feel, and some of the facts probably I'll share with you folks tomorrow.
Any other questions? Please.
Question to Khuzaima. You've been particularly positive about your outlook in markets. So if I ask you to wear a hat which tells you what you're going to be doing in the next 2 years and 5 years, which are the markets you think specifically in the next 2 years and 5 years would you actually move in or invest in?
I didn't hear the last part.
Okay. Which are the markets that you would actually go in next 2 and 5 years?
Which market you are going
specifically? I mean, would you
that
which countries?
That we're specifically positive about?
Yeah.
I think the biggest, I'll give you two very different examples. I think one is Turkey. I think Turkey is, I mean, most people don't realize this, it's the 15th largest economy in the world. They've already shown a willingness to take on a larger leadership role in the region than they have historically, which I think is a good thing. They have close ties with the Middle East, they have close ties with Europe, and they have close ties with the US. I think that they've managed to straddle a variety of fences all at the same time and maintain positive relationships with everybody, and they have a very industrialized economy. So for us, I think that that's going to be a big plus. And the interesting thing is that when you get further and further from Ankara or Istanbul, it's a lot less developed. I mean, when you fly into Istanbul, it basically feels like flying into Western Europe. When you go further into some of the rural areas, it feels like a developing economy. So I think that's one that's going to be big for us. I think the other one, both for us as well as for any company in the world, is Algeria. I think Algeria is a country that does not want to go back to the years that it had of civil war. The fact is they're sitting on trillions of dollars of natural resources. They have a decent infrastructure that also needs a lot of work. They have a lot of people living in Algiers, but also a lot of people living pretty far from the city center into some of the rural areas as well. And so while they share a lot of the needs of some of their neighbors, for example, not quite Libya, but some of the other neighbors, they have the resources and the money to spend on developing those needs. And so personally, I think, this is Khozema talking, not GE talking necessarily, I think Algeria could be bigger than Saudi Arabia for the region, just given how much that they have going there, and I think they've shown a little bit more openness perhaps than Saudi Arabia has.
One more questions?
One last question.
Last questions, please.
Yeah, I agree with your assessment that for the Middle East that has a weak infrastructure base and industrial base, the multinationals can play a role. The multinationals that we deal with in our sectors, where the whole Middle East is a very small part of their business worldwide. And that's likely to continue given the growth in China, India, Brazil, and so on. So how's that going to work going forward? You know, for the multinationals to play a real role, they have to see a real payoff. If the business is, maybe infrastructure is different, but other businesses, 5–10% of their worldwide income, what's the incentive?
Well, I mean, again, I'll speak from a GE perspective. I mean, I think if you simply look at the growth rates, let me start with this premise, which you may not know. We are larger as a company outside of the US than we are in the US. Okay, so GE is about 60% of our revenue base comes from outside of the US. Most people aren't aware of that. So as a starting point, we've been in other parts of the world for a long time, 100 years. So for starters, we kind of know what we're getting into in international markets. I think the second thing is that it's just math. When you look at the growth rates of Middle East, North Africa, the BRIC countries, Southeast Asia, I mean, the growth rates, okay, India and China may be exceptions, right? They're 8–9% GDP growth annually. But even the Middle East countries are about 5–6%, and they're probably punching under their weight. They could probably be 7–10% if they did some of the right things with respect to infrastructure. Yeah. I think the third thing is that for us, as a company, the smart thing to do is to go where the money is. And there's a lot of money in this region. It's not necessarily has historically not been spent on the right things. But if you look at, for example, the UAE as a model or Turkey as a model, I mean, here are two economies in which they're very vibrant. They have a desire to spend on the people and to build out infrastructure. And they're serving as models for other countries in the region. And so looking at that, looking at some of the other opportunities in the region, looking at the macroeconomic factors, we as a company, and I can't speak for all multinationals, but we as a company have staffed for it. You know, we have a lot of employees worldwide, about 300,000 plus, but we have today nearly 5,000 employees in the Middle East and North Africa. And we plan to grow that probably by 2x over the next 2 years. So I don't think that there's a lack of incentives to be here. For us, I can tell you that we're here to stay. We've been here a long time, and we're here to stay, and I think with countries opening up more than they historically have, enter Libya and South Sudan most recently, that we're going to be here for a long time to come, hopefully another 100 years.
Thank you, Mr. Chairman. For the session. Thank you.